It was the best of times and it was the worst of times. And no, I'm not talking about the famous Charles Dickens novels here, of course. I'm talking about the North American stock market indices. And the best of times so far in 2023 clearly has been the Nasdaq. And we can see, beginning the part of 2023 here, how impressive the run has been. We can see how it's trading significantly above its 200-day moving average there. I wonder if maybe the Nasdaq isn't getting into a bit frothy territory. We look at it from a very, very simple RSI technical metric here, and we can see that it's trading technically in overbought territory. Best of times, worst of times, when we look at the Nasdaq in comparison to its peers here, we look at the S&P 500 barely up. We look at the Toronto Stock Exchange down a little bit. We look at the Dow Jones Industrial down almost 2%. And this is from the last time we updated in this series. So this series, for those of you who might be joining us for the first time, started back in August of 2022. And we're looking at 6 different indicators every month with the goal to sort of get a sense of, have we seen the worst of the correction that started at the beginning of last year? So far, when I assess these, my answer is leaning towards no. As I've said in the very first video in the series and everyone since then, I don't know the answer to this. I'm assessing the data, and each of you will have to take this, of course, and apply it to your own portfolio management styles and see if it makes sense for you. Since the last update, as I mentioned, you will recall everything was up the last time. So from March to April, we can see by this chart here, everything was strongly into positive territory. Since then, there has been a divergence, and in the last month, we see the Nasdaq up more than 6%. The rest of the indices, like we just looked at, either flat or slightly into negative territories. If we look at 2023 year to date, strong number there from the Nasdaq. The S&P 500, again, showing good returns. The TSX as well. The Dow Jones basically trading flat on a year-to-date number. So in this series, we look at what's happening each month. So when we update to today, I want to start with the yield curve, which is what we always start with. And I'm using in this series the US 10-year, 2-year yield curve. Yeah, the 10-2, and I'm using the 10-year, 3-month yield curve. The key here is this. If we're going into a recession, I'm going to make the assumption that the markets will drop, and either we haven't seen the bottom of the correction yet, or if we're maybe setting up for a significant drop, even if it doesn't quite get down to the previous lows. An inverted yield curve often precedes a recession, and we can just see a little bit of history here. We go back to 2000. The orange line is the 10-year, 3-month yield curve. The blue line is the Dow Jones Industrial Average, and the gray shaded areas are recessions, now that we can look back and those have been locked in. If we look back to 2000, we can see the yield curve going negative beneath that dotted line, then turning positive, followed by the recession, and as we can see here, a decline in the stock market. In 2007, the yield curve went negative, turned positive, followed by the recession, followed by the decline in the markets, and then most recently in 2019, we see that repeated negative yield curve, turning positive, followed by the recession and the accompanying drop in the stock market. So where we are today, we see that the yield curve is significantly into negative territory. What we haven't seen yet is the official start, and we won't see this until hindsight, obviously, start and end of the recession, and we haven't seen the corresponding drop in the stock market. When we looked at these numbers last month, so in April, we saw that the 10-2 was relatively flat, and in fact, it's been trading flat for quite a while now. We looked at the 10-year, 3-month, which had gone further into negative territory. Updating to today, the 10-2 continues its sideways move since around November or so of last year. That's what we've seen. And the 10-year, 3-month is well into negative territory, flattening out a little bit there. Remember, the curves typically, historically, will go positive, then we see the bottom of the market. Today, with these both being in negative territory, the result to me is crystal clear. No, we haven't seen the worst. That was my verdict last month. No change this month. I want to look now at the second metric, which is moving averages. First, though, I do want to remind you that in addition to our YouTube channel here, we also have our Investing Academy, and this is our online platform where we work with Canadians from across the country of all ages, and we help educate about investing and financial issues in general. The course material is specifically designed to take you from a raw beginner to a fully confident investor. So I will put a link in the description of this video. Second metric, moving averages. I'm using the S&P 500 as the stock market proxy and the 200-day moving average. In April, we saw that the S&P 500 had moved above that moving average. It has been very indecisive. If you look back over the last number of months, you can see the up and down. It crosses, goes back, crosses and goes back. Today, we see that the S&P 500 has broken that seesaw pattern of recent months. And in fact, now for 2 consecutive months, as we've reported, it has remained above that moving average. Now, I want to look at the Nasdaq as well, because we did mention that the Nasdaq is in the best of times scenario right now. When we look at that, it has traded since about mid-March above the moving average, showing some very strong strength there. The result, well, last month I said maybe, and I'd like to see a sustained period of time trading above the moving average. This month, I'm going to again give it a maybe and look forward to checking next month and seeing what's happened there. If we get a consistent trend, I might move that up into the yes category, but for this time right now, I'm going to stick with a maybe. The third index, the third metric rather, is the volatility index, or the VIX, and this measures market uncertainty. It measures calmness or fear in the market. In April, we can see here that it was well below the long-term average. So the red dotted line, the red dashed line, is around 20, which is the longer-term average, and we can see that the VIX was trading below that at 17.6, and that means, at least at that point in time, the investors in general are confident and comfortable with where the markets are. When we look today, again, it is lower, and I don't know if someone out there can tell me why this is the case. You would expect, with a lot of the uncertainty out there right now, that the VIX would be trading higher than that long-term average, but it isn't trading right now at about 16.8 roughly. Question I would have, I guess, was last summer the spike that I've been looking for. When we look back at this chart here, we can see sort of a series of ups and downs there, trading, tipping up at around that 35 level. We saw the markets coming down, indicated by, in this case, the Nasdaq there with the blue line, and now it's settled back down into a more calm area. The market definitely is comfortable out there. Should I be changing my view on this? I've been expecting a spike, and I haven't seen one. Last month, my verdict was no. I'm going to move that to a very, very cautious maybe here. As we've talked about virtually every video in this series, you look at all of these numbers, these metrics in aggregate of one another, and the left side of my brain, I guess the numbers side, is telling me that no, this chart is not saying that we have seen the worst of it yet, but the right side is thinking, hey, let's apply a little bit of creativity here and take a cautious maybe with the VIX in this update here. The fourth update we look at every month is the U.S. jobless claims, and this is a metric that will measure applications for unemployment, and it will fall for the first time since the bear market began. So if we look at the last month here, we've seen sort of a slow uptick. Late 2022, we saw that increasing and then flattening out. We want to see that drop. When we look at the chart today, at best, I would say this number is flattening, but I don't see a really strong move down. The latest U.S. Department of Labor news release states in the week ending May 13th, the advanced figure for seasonally adjusted initial claims was 242,000. The 4-week moving average was 244,250, a decrease of 1,000 from the previous week's unrevised average of 245,250. And I like to look at that moving average to get a little bit more of an idea of the trend. My interpretation last month was no. There's nothing here that shows us, because we haven't seen that significant decline. It is nice to see this flattening. Today, I don't really think that it's showing anything strong, but I'm going to move this into the maybe camp. There's nothing concrete that I'm reading either up or down, so I'm going to be maybe generous with my interpretation this month and say maybe and see how that falls into the bigger picture here. Fifth metric is the Baltic Dry Index, or the BDI, and this number, this chart here, should go up before the market finds its bottom if we can use history as a guide. When we looked last month, we had seen that the BDI had sort of flattened out and trading in a range. This time, when we look at it now, we see a slight tick down. So that's not really good news. The Marine Link website, May 15th, says the Baltic Exchange's main sea freight index fell to its lowest point in nearly 3 weeks on Monday on weaker demand across all vessel segments. And that sticks out to me, all vessel segments, not just one little pocket here and there. The overall index was down 36 points or 2.3% at 1,522 points in its third consecutive decline. So nothing really jumping out at me here either way. Again, this sort of puts me in the maybe camp, which was the same as the last update back in April. I said maybe. I'm going to leave it there and let's just see if it's able to maintain the levels that it's at right now. If nothing strong happens either way, we can maybe lock that in and hopefully get some positive news from there. But I'm looking forward to next month. I think a lot's going to happen over the next few months, so I'm looking forward to seeing how that develops. The sixth and final metric that we look at in this series is the PMI, and this is another recession-related metric. Obviously, we want the economy to be expanding. We want manufacturing to be expanding, and that's what this measures. If the number comes in above 50, that means the manufacturing sector of the economy is, the manufacturing segment, I guess, of the economy is expanding. If it comes below 50, that means it is contracting. The latest numbers are in for April. Now, remember, in March, that number came in at 46.3, so we had a contracting segment of that economy. April's number comes up a little bit at 47.1. So you might think that that is sort of positive news, and it is because we've reversed that trend, but still we're below 50, so we're still in a contraction phase. The Institute for Supply Management website says the U.S. manufacturing sector contracted in April as the manufacturing PMI registered 47.1%, or 0.8 percentage points higher than the reading of 46.3% recorded in March. Of the 5 sub-indexes that directly factor into the manufacturing PMI, only one, employment, is in growth territory. That concerns me a little bit because there's not a lot of broad strength as we see by that chart there. Now, when we look back to last month, we can see the chart had continued to slide down on the right side of the bars there. We'll see it continue to move in a downward direction. My commentary then added that this was the 5th month of contraction and a continuation of the downward trend. Today, you can see here it says this is the 6th month of contraction and continuation of a downward trend that began in June of 2022. So we can see it is the 6th month of contraction, but as we see on the chart here, this most recent number is slightly higher than it was previously. So another contraction month, but a little bit better than the month before. So last month, again, I had said maybe because of a little bit of flattening, and this verdict is going to be maybe as well. I think we're going to leave that there and see what next month brings. So when I do this in summary now, we look at the moving average. To me, that's saying, I'm going to start with the yield curve. The yield curve is saying no, definitely we have not seen the bottom there. Moving average says maybe. The VIX says maybe. Jobless claims say maybe. The BDI is maybe, and the PMI shows maybe. So this is definitely the most optimistic, the most positive report since I started this series. That's one way to look at it. The other hand is, you have to look at, in aggregate, how much weight do you give that? There's 5 maybes. We have a no, we have 5 maybes, and we have no strong, obvious yeses. So despite the euphoria almost in the Nasdaq and the gains we've seen recently, to date, nothing firm. When I look at all of these numbers in aggregate, says to me that we're through the worst of it and it's all uphill from here. In fact, there's a big part of me that's saying be cautious. I don't think that's happened yet. As always, you cannot rely on this information solely to make your investment decisions. As I say, I have a little bit of anxiety still there. I'll factor that in as well. Take these data series and use them for your own purposes, please. In this series here, we do talk about specifically the direction of the market. Have we seen the bottom or not? Those are traditional numbers that we can use to make this assessment. But what about the broader overall market? I'm doing a quarterly series. Will be coming up again, I guess at the end of June will be the second quarter. But for the first quarter, you can see that update right here. Prime yourself, get ready, and we'll see what changed in the coming month or so. So thank you very much, as always, for watching this video. I do look forward to seeing you in the next video.